Good afternoon, everyone, and welcome to Stock Market Today for Friday, May 16th. It's Alissa Coram here, and it's the moment we've all been waiting for. The power trend is officially here. We'll talk about what it means for traders, how we should be positioning ourselves here as the market continues to rally powerfully. It was a powerful week for this power trend to get engaged. And joining me now to discuss that and so much more is my colleague, Mike Webster. Good to see you, Webby.
Wow, what a week, man. It feels like it's been like a month just this week. So just so much going on. So it should be a fun show.
Yeah, a lot has happened, a lot that we need to update our audience on. So let's just get right down to it. We're going to talk about the action for the major indexes at a high level. We'll go over the sector action, some stocks to watch, and of course, Webby's charts, which are key to giving us that deeper perspective as to how we should be thinking about where we're at in the current market trend. So starting with a look at the NASDAQ composite, we ended the day on a high note, the day on the high note, the week on a high note as well. So the NASDAQ up 0.5%. The S&P 500 extended its gains throughout the session, up 0.7%. The Dow up 0.8%. And the Russell 2000 up almost 0.9% on the day. And you know, Webby, when we started IBD Live this morning, we were thinking, are we even going to get some sort of update? We were kind of just waffling around, and then it seems like we just gained strength throughout the day, making that last thing that we needed for the power trend official with an update. All the moving averages stacked, enough time has elapsed. So it seems like all systems are go.
Yeah, now we always take things one day at a time and we don't predict, we just interpret. But with that said, a power trend is a big deal. So let's kind of just address that. If this is a new term for some folks who are watching, this is something that I developed along with Justin and Charles Harris back when we did, IBD's market school rules, which we developed around 2011, and those are black and white rules that we wanted with absolutely no room for judgment. Just if the market does this, then it's a +1. And if it does this, it's a -1. We just tally up those numbers, and it tells us how deep in the market we can be or what our max exposure is. And when we were doing that, we realized we were trying to mimic how Bill O'Neill, the founder of IBD, actually traded. And he would say things sometimes and then say the complete opposite at other times. And we were trying to figure out, like, we knew what he really meant. And so we wanted to define it. And that's what we did, is when there were times where there would be just a little bit of distribution, maybe 4 or 5 days of distribution, and he would say, you need to be out of the market. Then there are other times where you would have a lot more distribution than that, and he would have all of us PMs on margin, back in the day. And so we're like, where is the disconnect? So the three of us just went through, did some original research, and we figured out, there was these times in the market where you get these powerful moves up, and then we trace back and we just wanted to say, okay, where could we start that as soon as we could, but not too soon? And then how do we end it? So we wanted to make it simple, because that was something that Bill was always about, is keeping it very simple. We could have made it better, but complex, but we erred on the side of simple. So it's just 4 rules. The easiest one is an up day. So yesterday we could have had a power trend on NASDAQ, but we closed down for the day. So we wanted to have an up day because that was in line with Bill's philosophy of increasing exposure on up days, not on down days. Now the other easy one is the 50-day, which is your red line in an uptrend, and that's happened for a few days. Those are the easy ones, but the ones that are hard to get is the low versus your 21-day has to be above it for at least 10 days, 10 consecutive days. And at the same time, your 21-day, which is the green line, has to be above your 50-day, the red line, for 5 days. And what that does is that that puts enough momentum going, especially with the 21 over or the low above the 21, telling you that the shift is happening, and you want to get on that train, and stay on that train. In that, those are the times where you err on the side of playing offense. Now, last week and for the last few months, you were err on the side of defense because you were underneath that big deal, which is the black line, your 200-day. And this might sound like some mumbo jumbo with all these different lines if you're new to technical analysis, but the 200-day is a big deal. 21-day and the 50-day, that's more for us and in our style of traders, but everyone in the industry looks at the 200-day, even people who are just fundamentally based and don't use charts at all. So when you're underneath that, and especially all the algos out there that run, large amounts of money, I believe that they use the 200-day, because I've created, an algo for William O'Neill back in the day. And when I did the back test for a few years of just working on a bunch of back tests, you quickly find that being above the 200-day, you get good results. Underneath the 200-day, you get choppy or bad results. So it's a big deal. And that was an overhang. So we got through that. So then we were leaning more bullish, but now that we have this power trend, we're going to, lean even heavier on the gas. Now, with that said, we're really up there. We're really extended. So you're always asking yourself what's normal and natural, and what would be normal and natural would be, some sort of test along the way, and it'll be news related. Most likely, it'll be something that just comes out of the blues, a tweet from President Trump or something from tariff related from another country. It doesn't seem like it's going to be economic news. Today it was fascinating because let's go back to the intraday chart. And I know you know what I'm going to say, so you go ahead and go there.
No, you can talk about it. Well, we had some updates to the 12-month inflation data and the longer term inflation expectations revised higher.
Yeah.
So expectations for inflation to go up. Also, sort of mid to late this week, Walmart, a big bellwether on the retail front, talked about raising prices due to tariffs. So it really seems like the market is taking a lot of the tariff and the inflation news in stride.
Yes, well said. And so you can see when the inflation data hit this morning, half an hour into trading, normally, meaning anything prior to this week, really, that would have taken the market down, because the thought process is Powell really does not like inflation expectations. Historically, he does not like inflation expectations being high, because that creates lots of problems. Let's just, without getting into the weeds, creates lots of problems. So when you get negative news and the market doesn't really go down on it and then eventually goes up on that same day, that's more important than the news itself. The reaction to the news is saying it's just brushing that off. What I think is people are just off sides, and that's reasonable because of all the news and being underneath the 200-day. And going into last weekend with, the obvious catalyst that we had, where the talks with us in China went well, and no one was expecting that. So you get a lot of people that were short, that were getting squeezed. And then that is the best type of buying, because they need to cover right away. And that pushes things up, quickly. But lots of times it'll just fade back down once the shorts are done, getting squeezed. It'll just go back to wherever the trend was before, or chop around. We didn't see that. It built on itself. So then I think you had two things. Yeah. You had your initial thing was shorts covering, and then you had people saying, you know what? The news has changed, and the tone has changed, and I want to get back on this train. It's not going to be an easy ride. It never is, but you have to completely change your mind. Even if we didn't have the power trend, just staying above the 200-day for a week, that's a big deal. I've got the 3-day rule where you're low above it for 3 days and closing up, and we got that, and now we've had extra. So all is good. And I hate saying as I'm saying these words, it's scaring me to death, like we're going to cap down 20% or something,
Yeah, where's
because
the
you
boogeyman
never
around
want to
the
be
corner?
that bullish. But
Yeah.
the reality is, it looks like we're at magnitude highs. Will we do it without testing, testing us? No, that hardly ever happened. It's happened, but it doesn't happen very often. Back in '99 it happened, late '98 it happened, in '82 it happened. There are periods of time in '78, '79. There are times where you just run up. And I guess the closest this would be to that 1998 bear market that we had, because it was about the same depth in roughly the same amount of time. And from there, we went straight back up. Oh, thanks for going there. Yeah, that one was a double bottom. It was 33% deep. This one, I think, was about 27%. So not as bad, but close to it. And look at that, just going up that whole way. That is a bad tick in there where it goes down to 170 or 1766, but that just held above that 21 day. And anyone
Mhm.
who's waiting for the pullback to buy and saying it's too high, well, they were, the kids these
Waiting a
days,
while.
yeah, calling it a lockout rally. And that's the reality. So you want to be flexible, bend like a tree in the wind.
Yeah, well said. A very interesting precedent that we've been monitoring over the last couple of months. And Webby, I think that are we going to get a pullback? The more extended we get, the increased odds that we have for said pullback, but it doesn't necessarily mean that we're going to get one. I think when you're in that sort of situation, that's why it's so great how I love that you've instilled in us the concept of being incremental, right? And looking at these different signals along the way when you do get a trend change. We've talked about your trend change checklist on this show, and Rachel Fox on our team came out with a video this week summarizing
A great
uh,
video.
your checklist and the points. Yes, a great video. So if you do the incremental exposure strategy, you shouldn't have to be as worried here about, okay, well, what about buying here? I feel underexposed. Am I going to get shaken out? How aggressive do I go? Because you have hopefully some sort of cushion at this point. But I think, some traders may have gotten caught off guard by this week's action. And like you, I was also very impressed by the way that we got above the 200-day. It's not like we just inched above it and hit some resistance there. We punched through that level and continued higher, finished at highs for the week. Obviously, we'll see what next week brings. But I think, when you have also a lot of bearish sentiment out there, some financial publications, recently talking about investment managers the most bearish in 30 years. You have all of these reasons that you could be bearish, but in our case, as contrarians, help us lean a little bit more bullish, and ultimately, the charts are our guide. So hopefully, the incremental strategy has been working for traders out there up until this juncture.
Yeah, and it would be incremental on the way out as well, but
Yes.
with a fat, depending on
Mm.
how it goes through things on the way down, sometimes you have to go faster. So for me, the 21 day is the biggest deal. So as long as we stay above that on a closing basis, my gas pedal is going to be on. But could you see how far away from that
Yeah.
21 days?
It's a long trip down at this point with the recent strength. We're 6.5% above the 21 day.
Yeah, so
We've
that
got some
is a
room.
lot of that's a lot of risk. So you always want to be thinking, okay, where is your exit, whether it's an individual stock or on the indexes, and say, okay, wow, I'm not going to be, know that I'm wrong until I'm down about 7% from here. And if the index is down 7% before you take action, your stocks are probably going to be down 14 or 20%. So as that's happening, if you're heavy, you need to be gradually getting, backing away, so you don't just have your pedal down the whole time. Now I will say, people are probably wondering, like, oh well, when does the power trend end? It officially ends when the green line, the 21 day, crosses back through your 50. That's a long time from now. So let's just say we just started collapsing. It would take a long time, just if you do the math,
Mhm.
for that to roll back, a 21 day and a 50. That's going to take some time. So that's when it's over, but that doesn't mean you wait for it to be over to
Right.
react. That's why I lean heavily on the 21 day. And before that would be the 200 day. So if we can't hold the 200 day, and how far are we from that one?
Let's check it out. We are 4.6% above the 200 day.
That's still a ways, but it's a lot better than
Yeah.
7%. So that's your first real guardrail. And if we fall
Mhm.
back below that, then you got to change your tune. But as long as we stay above it, and especially the low staying above that one,
Mhm.
that's very important to me.
Yes. All right. Let's also just put into perspective the weekly percentage gains. The Nasdaq up 7.2% for the week. The S&P 500 up 5.3% for the week. The Dow up 3.4%, also getting above its 200-day line this week. And the Russell 2000 up about 4.5% for the week. We know it's been badly beaten down, but I would say that this is some pretty impressive movement here and a big development for the major indexes in terms of this week's action.
It's huge, frankly. If you would have asked anyone, including myself, when we were at the lows, what are the odds of us snapping back like this? Um,
Yeah.
Very low, like very, very low, because you don't have many examples of it. You really have COVID. The COVID bear market that bounced right back was about the only V-shaped one. And when we don't have to go back to it, but the 1998 one, that was a double bottom, and that was very short. 33% bear market being super short. That's your normal precedent. So a trip back down to our lows, as we were coming up, that was kind of a base case. Like that was really highly probable. So,
Mhm.
but it's news driven. Like, let's just be real. If the talks on last weekend would have gone the other way, and let's say, both China and the US, started, a bigger war, and think back in the days of the Cold War with us and Russia. And, that can really create a lot of problems. And yeah, we would have gone down. So it's a lot of it is news based, but then what you do is you interpret that news and what the market's doing with
Right.
it, just like the smaller news that we saw today with the inflation expectations and the
Mhm.
market just brushing it off. I mean, we didn't even take out yesterday's low. Like that is really powerful. That's it.
Yeah.
That's telling you a lot. And well, it's just anecdotal, which I don't like to operate on. Whenever I put anything positive out on Twitter or even comments made, on the show, like seeing some of the negative reactions, like, you're crazy to be even bullish, I love that because
Yeah.
that means, that's just,
There's people on the sidelines still.
yeah, and that's fine. Like, I don't mind if someone disagrees with me. Like, that's what makes a market, and that is actually interesting. To have a
Mhm.
conversation. Oh, why are you bearish? Oh, okay. Well, you might learn something from that. Someone who's bearish in the midst of this, and you'll learn something from someone who's bullish. But if when everyone is bullish, well, there's no one left to buy, and that's a problem. That's why I try to temper myself. I'm super bullish right now, but I'm just trying to look and see, okay, where could the problems be? And really, the problem is going to be this random news event that we can't really plan for. So you just have to the
Know your
the thing
levels.
know the levels, and most importantly, for everyone who's watching this weekend, go through all of the stocks that you own and grade them A through F, and then also put on their stops, because if we get some negative news and we're way down, we're down 3-4% on, you don't want to be a deer in the headlights. You want to know, okay, this is my A stock. I'm going to try to hold that to the end. I'm going to sell my F, D, E's, and C's. You shouldn't own any of those, but maybe you own some D quality stocks. Those would be the first to go. Obviously, anything that you would be down on, you would exit. So you always want to be thinking, if there's problems, what do you do?
Yeah.
Just don't go, oh, it's a bull market again, and I'm just going to gun it without,
Mhm.
and I'm just going to sit and
Planning.
hope.
Yeah.
That's not a good strategy.
Yeah.
Plan.
A great actionable nugget there. Grade your stocks, have that plan, and then what to do if we do see the market turn tail. Great thoughts there, Webby. All right, shall we move on to the
Yeah,
sectors?
let's do it.
Okay, let's check out our sector action this week. So down the most on the day. So this is a day sort. NRG. This has been a lagging area. We did see, we've seen a couple of names. Landbridge. Is in the U.S. Explorers and Producers Group. Broke out today. EQT, I know, is another one that some folks have brought up on the show, including the show has an IEBD live, including our special guest today, Don Vandenborg. I know I believe the leaderboard team watching this one as well. So there are some stocks in oil and gas, and we know that XLE has heavy weightings in Chevron and Exxon, but just an update there on the energy sector. We also have technology. We're now just 3% below prior highs here for XLK. That's pretty impressive. And since the follow through day, we've seen some notable outperformance here in technology stocks. Financials, looks like we are continuing to see gains for the sector, but maybe not quite as strong as money flowing to other areas. But there are some notable stocks on the watch list, like Interactive Brokers. Webby, I know this is one that you are watching. I feel like JP Morgan, that was a recent breakout that traders on our team are watching as well. And then you have communication services. This has your Google and your Meta in it. A lot of updates here, so continuing to see improvement. This is basically, looks like it's keeping pace with the S&P 500. It seems like we're starting to see more participation, which is great, but we're also seeing a little bit of a difference between where the leadership is. Some of the mega caps, look a lot better than others. And I know, Webby, this is something that you have pointed out, where you don't want to just get exposure for exposure's sake in some of these super liquid household technology mega cap names, but you really want to find the ones that are leading right now.
Mm-hmm.
Okay. And then consumer discretionary, you've got your Amazon and your Tesla in here, up 7.5% for the week. So roughly the same performance as the NASDAQ composite. Materials here, XLB, relative strength since that follow through day, more like relative weakness at this point. Although in terms of materials, steel, CRS, that was one that is a standout here in the current market with a recent breakout after earnings. This one's working for now. XLI, your industrials, Webby, this is pretty impressive. Look, we're basically back at highs for the industrial sector. You have your GE, your Boeing, and even your Uber in this. And full disclosure, I do own Uber, but this is a pretty impressive comeback. And I'm going to keep talking.
I'm just listening. You're doing such a great job. I've got nothing
No,
to add other
we've got
than
plenty to share later, so we'll just keep going.
keep going.
Consumer staples. Interesting action on Thursday and Friday of this week. I would want to dig in and see what was driving that performance, but in terms of the weekly action here, you can see that relative strength over the last 4 or 5 weeks or so, money rotating out of this area generally, which is great because it's more of that defensive area. We want to see rotation, continued rotation into your risk on areas. Real estate looks like it also had a nice day on Friday, but also a weaker group over the last couple of weeks, which we do not mind. Utilities, this is an interesting area because traditionally defensive, but you also have your AI as utility stocks in this group that previously fueled some notable outperformance. And it looks like we are seeing a rotation back into some of those AI utility infrastructure type plays, one of which we will be talking about. But some nice gains on Thursday and Friday. And I know the UTES, which looks even more like those standout AI utility plays that we've been talking about, like your GEVs. This was recently added to Swing Trader. So just wanted to make a quick note there. And last but not least, healthcare outperforming today, but this has been I would say, the weakest sector really since the market bottom, and it recently undercut its lows from early in April. So a huge signal there of that continued weakness, even with the bounce today. All right.
Impressive work there. Yeah, you do such a good job. I got nothing to add. Just from a compliance standpoint, you mentioned a few names that I have positions in, like UTES, and I think you mentioned Tesla and Uber that I have positions in. But man, you're a superstar.
Well, takes one to know one, Webby.
No, just a random dude. Should we? Oh yeah, it's the stock time. I forgot.
Yeah, we'll take a look at a couple of stocks. So we talked about the AI utility theme. So let's talk about NRG, Texas-based company here in the utility sector. And what an impressive move this week on earnings. It had already broken out technically of a double bottom ahead of the report, was right around highs at 117 just before it issued. And this week, wow, what power here. Up 33% by week's end. So this is really impressive. What do you make of it, Webby?
Okay, I do have a position in this that I just bought late in the day, and it was really looking at the entire area. And for most people, they would look at that, especially the weekly chart, and say, "Well, that's crazy. Why would you buy that one? Why wouldn't you buy some of the ones lower?" And the way I'm built, and the way Bill O'Neill, the founder of IBD, was built, is that you want to buy the leading stock in the group, and just the things that you mentioned there kind of tell you that it's a leader. It was the first one that broke out of that base and was acting well, and then you had such a powerful move on the earnings. And I was waiting when that earnings happened. I was hoping that you were going to form this underneath that first bar, but they made it even harder. So some of the times the best stocks, if you study them and you go back and you study the models, that they don't give you a good entry, and it makes it very hard, and you have to chase. And that's something that I would do with Bill back when we ran a list together, like what, the swing trader that I do with Justin, and leaderboard that the other guys do, that Ken and Dave do primarily. That when a stock was up like this, if we didn't have it on the list, he would say, you just put it on, because that's your best merchandise, and you want to get it on and then figure out a way to get into it, even though it's well extended from your typical 5% past the pivot. You can see up in the top right hand corner, it's 53% past that. So you're taking on more risk, but you're trying to get the best stock. So if you're buying it here, then your expectation is for it to move up higher from here. So really using the lows from the last couple of days is what I'm going to be using for this position. If it goes back down there, I'll just back away from what I bought today. No harm. The worst thing that could happen is a big gap down, and that happens. If you're going to worry about big gap downs all the time, you're never going to trade, right? So you go into it, your exit, but lots of times this will just inch up from here. And it reminds me of back in the day, we don't have to go there, but BlackBerry, which was RIM at the time, had this big gap, gap bigger than this. And we didn't put it on the NSME list. And then a couple of days later, Bill called up and he said, why didn't we do anything with this? And he was upset because it was too extended. And I learned from that lesson that the best names, and that went on to have a big move, because they start off like this, and you get a lot of institutions and they're pushing it up, and they don't have their full position, and now they need to continue building it. But they also have smart traders in there, and they know that there are people like us who are reading charts, and at times they'll try to make that chart look as ugly as possible to scare you out, and then so they can soak up the shares that they still need. So with that, you can't just buy something up here like this and just hope for the best. You have to have an exit strategy. But this is not for everyone, So the other way to do it is through UTES, which this is a part of, and that's the one that we put on Swing Trader. And that's also something that I own a position in. And so there you get some of this. I think it's like a 4 or 5% of it, and you get a bunch of other ones that, some of the laggards in the group, because they can't all be leaders, right? But this would probably be the way for most people to play it, and then I would use the low from yesterday or the day before as your exit, and this is probably for people who have a normal risk tolerance. Mine is a little higher than average.
Mhm. Lots of great points there, Webby, and I think that, the key thing that I'm taking away from this NRG chart is the fact that if these are the types of setups that are on the table, that's indicative of the power of this power trend. Again, like you said, you always have your exit strategy. We're not predicting, but if you are in a strong market with the wind at your back and you can lean more aggressive, then these are the types of stocks and setups that you should be keeping an eye out for. So I think that that is very telling of the kind of market that we're in if setups like this are on the table.
Absolutely. Well said. And I think Kenny Rogers had a lot of good advice for us in this department.
You're going to have to connect that dots a little bit more for
Oh,
me.
everyone gets it. The gambler.
Everyone,
Yeah,
everyone to me.
everyone gets it.
All
They,
right.
they do, trust me.
Okay. Let's go to Bros. This is Dutch Brothers. This is, I would say this is one of the retail trader favorites out there, like your Robinhood and your Hims and even your Palantir, which I do own. This had a pretty deep base here, Webby, corrected some 46%, and kind of a sloppy looking double bottom, not the prettiest base pattern we ever saw, but it did clear the 72.72 midpoint today. Earnings out of the way last week, that helped fuel shares back above the 50-day line. So this is a fundamental story that's very compelling. It's showing up in the quarterly numbers here, and today cleared a potential entry.
Well said. I do have a position in it, and we did put it on Swing Trader. I was going to just buy it myself because the base is so terrible. Let's go to the weekly. It's probably one of the worst bases I've ever bought in my entire career. If you want to know what a bad base looks like, it's this one. Everything about it is wrong. It's wide and loose. It's all over the place. The bars, lots of bars closing at the lows. Um, it's really problematic. You gotta keep it real, right? You got to be intellectually honest. But I have seen some stocks in our models, and that's what everything is based off of, the models. And it reminds me of Hansen, which is now Monster, and people over the weekend can go back and study that. Just look at it monthly and see where it had its biggest moves, and then trace back and look at those bases. And it was some of the ugliest bases, not as ugly as this, but pretty ugly, that they broke out of, and it had these monster moves. And what was going on there was a fundamental shift.
Yeah.
They were one of the key products out there in that space, and that's what drove it up. So lots of times the move will be really just based off the fundamentals, or they're always based on the fundamentals. But what I like about this is I put my Peter Lynch hat on, and I go to them. And in fact, I drove like first time I drove like 40 miles or something when I was trading it the first time, just to because there weren't any local ones here in Austin, and so I drove down and went to it. I was so impressed because they would have two lines going in. It was very reminiscent of In-N-Out, which is a private company, and all the employees are super nice and super friendly. And so what does that tell you? That tells you they're not going to have a lot of turnover with employees. Same thing, you see with Costco, is they have very low
Trader Joe's.
turnover versus like a Walmart and a Sam's Club, because they keep their employees happy. That flows down to the bottom line. And with their employees happy, you go there and it's like they're asking you how your day is, and they're sincere, like they really want to know. And so you tell them, and then they ask you more questions. It's like, dude, you've got a line behind me, like go talk to them. It's so pleasant. So that is overriding this chart. And now let's go to the daily and just tactically go through. And you made a lot of the points, so I don't have to go over those again. I'm looking at this as a double bottom, and that was your pivot, the 72.72, even though pattern rec is showing it as a cup because it's not a normal double bottom, because that move up from the 47.26 happened in a kind of haphazardly way, and typically double bottoms go straight up from there. So that's another flaw with it. But it was going through there, and then the lows that you have from the lows from a couple days ago, that's your exit on this. And so this is a wild stock, and it's a crazy trader. So it's not for most people. If you want to trade it, I would just do a small position. I mean, I don't have a small position, but we'll see. I could have a small position 5 minutes into the open on Monday if if it's down a bunch. But yeah, we'll see how this one plays out. It's a high. These are both super risky positions. They frankly are, but because we're in the power trend and we're above the 200-day, it's allowing me to do this. I would not have done these trades a week ago because we were stuck underneath the 200-day. So you've got to know what the weather is like out there.
I'm also curious to look at the monthly. I just want to get your perspective on the updated monthly view here,
What
Webby.
do you see?
I see a cup with handle
Of
here.
course, yeah, I knew you
A little
saw that.
a little coffee cup, maybe taking shape.
There you go, a little coffee. Well, it's too late for coffee. It's just water with lemon, but it'll do.
Yeah. You'll in your mind, you're getting that that jolt that you need. But
There you go.
yeah, so I think the 80 level will be one to watch on the upside, as well as, of course, the prior highs from this
And
current
and
base.
for most people, if you don't wanna buy this, I don't blame you at all. I wouldn't, like, if it wasn't for the work that I've done with models and things, and also the Peter Lynch type of approach that I use, yeah, I would wait until you get up closer to 80 and it forms a cleaner entry. And so we're just talking about it to get it, on your mind to look at, but most people shouldn't buy this.
Okay. We'll round things out for this section with a look at Royal Caribbean, also forming the right side of a base that was on the deeper side and deeper than the previous base, which I know is kind of a flaw and an issue for a lot of stocks in this current market environment. Webby, the current base does have a depth of 41%, perhaps an early entry above a lot of stocks have these sort of double bottom-esque patterns within the cups that they are forming. They've been running a lot in recent weeks. So this is carving the right side of the base. And I think it is interesting. We were talking a little bit earlier about more stocks joining the party, right? More stocks, more sectors. So it seems like we are seeing a number of names in the travel space, whether it's your Booking, Royal Caribbean here, Viking even, which has earnings coming up next week. More and more participation out there.
Yeah, basically everything in this space, pretty much everything in this space, hotels,
Mhm.
booking, the this and CCL or the Viking, they all look good. I think the Royal looks the best. This and booking. Booking is a little on the it trades thin just because of the being the high price nature of
Yeah.
it. But I think that one looks good as well. But the RCL, that one, we do a lot of cruises. It's how we like to vacation, and they have a great product. I mean, their ships are wonderful, and we also like Carnival. I like all of them, Norwegian and Celebrity, but this one it's kind of a nice sweet spot. It's a little bit higher end, but not too pricey, and I think they do a great job with these mega ships that they have that really like 6,000 passenger plus ships, and you can get a lot of people on there, and they try to milk you for every penny
Mhm.
they can get out of you when you're on the ship. So that's good for the business, right? So and then everyone's happy. What's nice about it has been trending above that 21 days so nicely ever since it made it through the 227.56 double bottom area where you mentioned, and the RS line has been kind of just steadily going up there. It's not ripping up, but it's in this nice line above its moving averages. But as you mentioned something that I do want to touch on, the bases out there right now are not normal. Normally we would look at bases that where our current base is deeper than the last base and look at it as a major flaw. But the reality is bases are formed based off of the type of market environment that you're in. And the best stocks tend to, our type of stocks tend to go down, twice as much, in general, twice as much as what the averages do. So that means your best stocks are going to, our style are going to have gone down twice as much as the market. And so the market went down about 27%. So you're going to see a lot of ones where they're very deep bases. And so you want to look at the context. If the market had just gone through a tiny correction, let's say an 8% correction, which still would have felt bad, then a base like this, you wouldn't have touched with a 10-foot pole. Like it would be completely flawed, but you want to look at it in the context. And it was the same thing back in 98. Bill bought AOL and Schwab back then, and those bases looked horrible. But relative to the market, they looked really good. We did the same thing in 09. A lot of the bases that we were buying looked horrible, but relative to what the market was doing, they were holding up. And so the key there, if you don't know how to read charts very well, is just focus in on that green line, that RS line. First, is it trending above its moving averages? If not, you really want to probably shy away from it unless you're doing a portfolio management tactic of trying to just diversify. So like the Costco's and the Walmarts right now and stocks like that have weak RSs, but their stocks are, their bases look nicer. So trading those, nothing wrong with that, and blending it in, because on those bad days where all our normal heat is getting killed, those should buffer it and maybe even be up on the day, or should be down less. So you want to not just pick stocks, you want to look at your portfolio and see, you don't want it to buy CCL, RCL, Viking, Booking, Hilton, Marriott, all of those, because then if that group gets hit, you're going to get slaughtered,
Totally. Okay, so now we have 6 weeks up in a row off the bottom, which is powerful. So what about at this point, Webby? Do you wait for a handle? Because is this sort of, is it in no man's land? How do we think? Because so many stocks look like this right now. A lot of up days, forming the right side of the base, but haven't really paused a whole lot. So which ones do you do the NRG strategy with, and which other ones do you either wait for a handle, or are you just trying to find the best ones, and then you manage risk, whether it's a recent low or a percent stop?
Great question. And at 100%, the answer is determined by your risk tolerance as well as your ability to actually pull the trigger if the market rolls. And you always want to be thinking in the back of your mind, the market rolls hard the next day. That's every day I wake up thinking, today's the day that we're down 4 or 5 or more percent. What am I going to do? Because I've been in that situation. I've been through flash crashes. I've been through things. And, the first time you're like a deer in the headlights and you don't know what to do. And then after that, you can't be, because it's shame on you if you don't prepare ahead of time. So with this, to answer your question, for me, I would buy a small position and just use your line there, because if it's for real, it should move up from there. If it needs to form a handle here and it takes that out, well, if it doesn't shake you out there, it'll probably shake you out a week from then as it continues to form a handle. Because with a base this long, a 2-week handle would be a normal length, and that it would, probably come into the 21 day. So basically what my style is, just buying it up here, having that stop there. If it gets triggered, so I take a small loss. I'm not going to let it, if you're the type who you're going to buy it here and then it goes down there and you're going to vacillate and go, oh, well, maybe it's a low, maybe it'll bounce back later today. And then it's like, a slow death. Don't buy these. Wait for a classic entry. But the reality is, when the market turns like this and shifts, if you go back and study, bear market going into bull markets, lots of things, you've got to reach out into your toolbox and find other ways to get in. And I learned that from Bill. Like, he would figure out ways to jury rig it and get in there. But that's not for everyone. If you're new to this style, don't feel like pressured to buy things like this. Just wait for, an ideal thing, something you're comfortable with. There'll be plenty of time. If this power trend is for real, we will have weeks, if not months, to trade it. And so don't feel like you have to. But I'm just being honest about, I'm a racehorse,
Yeah.
but I will, I will cut and run in a blink of an eye too.
Great perspective there. All right. Are you ready to go over Webby's charts?
I was born ready, but
Great.
my sharing skills are not so good. Tell me, did I do
You
it?
got this. Yep. Spy
Oh, okay,
weekly.
good. We are going to do the great Bob Weir, take a step back and look at the weekly candles on here. And this is SPY. And this is a beautiful thing. Like, you just do not see action like this very often. And so we already had these nice candles in here. Last week was, it was normal and natural, and it was nice that it was a blue candle, meaning that your close for the week was higher than your open just a little bit. But this week, think about it, your real candle is all the way down to here because you had this gap up. So it doesn't ever get better than this. Really, it just doesn't. Let's look at the composite. Same thing there. Like, you don't get a bar better than that, and that implies that it wants to go up to the old highs. I mean, that's how you get a move like this. Let's move over to the regressions, and this is the regression that we had started on SPY back on February 19th, and we stopped this over here on 423. And then we broke through it on 424, and that was telling you that, what, the shift might be happening. And wow, is this just really a thing of beauty? And so once we get enough time out from this point to where we're at, we will get rid of this current downtrend one, and we will put a new one on up there. But it's just
Yeah. I
too
think it's about,
early.
we're getting close.
Yeah, we
About
are.
time.
And same thing there for the NASDAQ. Now let's switch over and look at our regressions, our 50% retracement. And we're using the high there in the middle of February and the low here at the beginning of April. And as we talk about all the time, we want to be in the northern hemisphere, which is above the 547.52 midpoint. And we're doing that. So that's a beautiful thing. And the same thing here with the NASDAQ, same basic time frame, and 17,447 is your midpoint, and we've been living above that. Again, a nice thing. Let's go over to our levels. I have not changed any of these lines on here for weeks and weeks and weeks because I wanted to see how it played out, which is unusual. I tend to just keep on putting ones on there, different ones on there, but I wanted to see how our levels that we had before, how it acts around each one. And each one it goes through like it's not even there. And so our next level would be the 598.51. But really staying above this 575.35 on SPY is what we want. And that's goes along with the old low from January 13th, and it's right around your 200 days. So 575.35 is an important level for me for that one. Let's look at our NASDAQ composite, and similar type of action there. This one, I would say an important level is the 18,831, but really the low from the 12th of this month. I should probably put one on there because that becomes an important level. So we'll see how that goes. And we always like to end this part of the segment with just stepping back and having a very clean chart and looking at the 21-day, which is your blue line, 21-day exponential, and focusing in this case, on your low versus it. And is it building and getting bigger? And it certainly is. That's exactly what we want to see. And we're always looking for problems. Like, what about this is not good? And here it is on the NASDAQ. And I'm not seeing anything yet. It doesn't mean that there's not something there that I'm just missing, but I'm staring at it looking for some problems. And so some of the signs that you'll notice when the market is starting to get a little ready to roll is you'll start seeing some pink candles in here. and some bigger pink candles, meaning that you close lower than where you open. And that's a sign that you're running out of gas. What you can tell with these candles being so small is it's just incremental now because we already had the big move, and that's fine. Like, what more do you want? So let's go over and look at the Webby RSI. How am I
Yeah,
doing on
because
time?
we're doing good.
Okay.
We're doing good.
All right. So we'll start with the SPY and the Webby RSI. This is starting to, we've been talking about this big move up that we had this week. And
Mhm.
what this measures is your low versus your 21-day expressed in ATRs. And when a market turns, you want to see a thrust where this gets really kind of overheated. Let's look back in
Yeah.
October, November of 23, you got almost up to 3 ATRs at the beginning of the move. And that's what you would like to see. So, frankly, we could get even more stretched, and that would be normal and natural. So, this is why I built this, is to know what is normal and natural and what is too much. So, getting up here to near 3 would be nice. It's going to feel scary because then we'd be so stretched from there, but that just wouldn't be a concern. And let's see. Let's look at the NASDAQ, and same thing there. We got a little bit higher on, this was good. It was about 2.75 or so on Wednesday. So that's good. But, even higher would be good, but it's better than what we saw with SPY. Now we'll look at our Bob Marley charts, my daughter's favorite ones of these. And you've got the green area, which is within 4 ATRs of your high. And you can see that we're back in that. We're only 2 ATRs off of our high at this point, which is great for SPY. And let's take a look at, and I do have a position in the SPY and Qs. I forgot to mention. And here, this one for NASDAQ, we're just about 2.5. We'll call it 2.5 ATRs off of our high. So we've made a lot of progress because we were down here in the red zone, down 10 ATRs not too long ago. So just beautiful
Yeah.
action.
Yes, a lot of progress indeed. Okay, so let's sum everything up and talk about the game plan for the week ahead.
Okay, so we're in a power trend. So you've shifted your mindset. Your exit strategy is the first line of defense is really our 200-day. If we go underneath that, even intraday, you need to be backing away because that could be the sign of us rolling down and having a double bottom. Like, you always want to think that's in the cards. And certainly with the type of news that we're having, if one of these countries wants to start playing hardball, or President Trump wants to, and he shifts, I don't think he will, because I do, this isn't politics, but you do have to be aware of the situation. One of the things that he looks at is what the market is doing. And he knows that, if the market's down, it makes it harder for him to accomplish things. And all politicians, red, blue, purple, anything else, they want to get things done, and so he wouldn't want to do that, I don't think, but another country could. And if that happens and you get a battle, well, all bets are off. And you would assume all bets are off. And really, does it hold the 200-day or not if we get some bad news? So be aware of that. But besides that, I mean, this is a time, if you're going to press, this is a time that you're pressing. But with every single entry that you do, know the exit beforehand. And I would email it to yourself, as well as put stops in on. Bill O'Neill was not a fan of actually putting stop orders in on the desk, but that's because he was in front of it all the time
Mhm.
and he never vacillated. But if you've got a normal job, or you're in meetings or whatever, or you're going to be traveling, put stops in. Now the downside is we could get a gap down that blows through your stops, so you have to be cognizant of that. But don't just buy willy-nilly and say, oh, Mike and Ali said it was a power trend, so I'm just putting all chips in. If you've been in cash, like you said earlier, incremental. We started off with a follow-through day, then we had a subsequent follow-through day, then we went above the 21-day, then our low got above the 21-day, and so on. We had all these things that you can watch Rachel's video on that triggered, and now we've got the power trend. So at this point, I'm deep in the market. We're deep in the market with Swing Trader, and I'm guessing you're deep in the market.
Yep.
So, but what to expect. We've been here before. Like, this is a bull market, and everyone's going to be concerned and saying, what about this? And what about that? And call me crazy for being bullish. I love it, man. That's fine. Go ahead, have fun, because study history, and there's that wall of worry. And there's always this negative thing. If there's nothing wrong, like if all things were resolved and the tariffs went down to zero across the board, and Powell said he's going to cut rates, so whatever President Trump wants, and deep seek goes away, like everything that people are concerned with goes away. Like, well, like that's not going to happen. So you're going to, and if that all happened, well, that would be the top, when all things are good. So it's good to have things to worry about, frankly, and we will see how this plays out. We just take it one day at a time. We do not predict, we interpret. But in interpreting, you want to know what's normal and natural. What's normal and natural is for us to go back up to old highs. That's normal and natural. If that doesn't happen, then it means it's abnormally weak, and it was just 1 week where everyone was caught off sides. Then you would go back and look at times like 2015 or in 2012, where things got very choppy. Then you got to get very small and very conservative, because then, man, you don't know what to expect. But right now it's acting normal and natural for a power trend. Very powerful.
Yes. And I think regarding the wall of worry, a good example that you pointed out where you had that, as well as a V-shaped recovery, you mentioned it, COVID, totally different circumstance, but how many worries did we have at that point? But the charts were telling us otherwise. So I think about that in the context of the current market, and we are seeing some risks that were on the table, headwinds that are now tailwinds, trade being one, the artificial intelligence revolution and spending related to that another. We're seeing a shift in both of those elements for the better, and a lot of stocks that are working. So the evidence is starting to pile up, and we'll have to see what next week brings, but very positive developments this week.
Absolutely. And what is your song of the week? Because I was just thinking about what it would be. Because we had Crossroads last week. So what is yours?
Let the Good Times Roll.
Oh, I like that. That's whoa, shoot. I was just looking up a song, and it started playing. So hopefully you couldn't hear that. I'm going to go with, and it was mentioned on today's show, so it's been rattling around in my mind. What was it? It was mentioned on the show.
Is that the Kenny Rogers, the gambling thing?
No, this morning's show, the IBD Live.
Man, you're making me have to think all the way back till this morning.
I know it was a long way away. It was Back in Black was mentioned at one point.
Oh yeah, that's right.
Back in Black, because now we're back above the 200-day, right? So we're Back in Black. Perfect. Or you could do another ACDC, and it's a long way to the top, which is getting smaller and smaller. It's not as far to the top anymore. And so we will see. We do not want free falling. We do not want free falling. We love Tom Petty, but we don't want free falling anymore.
Yes. Okay. Well, I can't believe I almost forgot about the song of the week this week, but you were prepared.
No, I wasn't. I was thinking of it mid-show. But one thing I would like to say before we end is last week I was able to do a podcast with our good buddy Joe Fahmy, who's on IBD Live all the time. He's been at the Founders Clubs, and he's one of the nicest people I've ever met. And I was on his podcast called Joe's Happy Hour, and we had a blast. So I would look that up and watch it, and we talked about a lot of things. And I didn't ramble too much. So it's only an hour. So you guys can handle an hour, right?
Yeah, absolutely. You did a great job. I was able to watch most of it. And a lot of videos I love watching in double speed. So, and podcasts. So easy to get through, this show with your morning coffee over the weekend. If you're not watching us live, and check out that podcast, Joe's Happy Hour. It was a good one.
Thank you.
Okay, that is it from us for this week. Thanks so much, Webby. And thanks everyone for tuning in. We hope you have a fantastic weekend, and we will see you back on Monday on IEBD Live, investors.com/IEBD Live for all the details. We will see you there. And then we will also see you right back here on Monday after the close.